look, there's two things going on. Elon's absolutely right. He's playing the long game, and he's saying if we're going to be the dominant leader over time, and again, the Chinese are coming, he's got to keep an eye on cost, and I think they're doing a better job of that than anybody else. In terms of net profitability, they are number one in the world right after Porsche. So if they can keep that up, they're going to be in awfully good shape. Plus, they also have the Tesla Energy division, which is growing like crazy. That may turn out to be their secret weapon.
A refreshing take on the third quarter earnings call from former Tesla board member Steve Wesley. And in this video, we're going to get insightful takes on the Cybertruck ramp, on the ramp of Tesla's energy business, on the ramp of Elon's emotions. There's a lot of ramping in this video, so enjoy.
I think they're going through a tough time right now with the Cybertruck ramp. But ultimately, what Tesla is trying to do is so revolutionary, it's so different from any other car company. And I think they will succeed. So you want to take opportunities like this when the stock is down and really, if you don't have a position, maybe take one.
Some financial advice there from Hayden. And look, the stock is dropping for what I consider to be reasons out of Tesla's control. Car affordability is the problem right now, and Tesla is trying to solve that by driving costs down. And Elon described it on the earnings call as digging a tunnel with a spoon. This is a game of pennies. Tesla has managed to bring their costs down by $2,000 this year, all while ramping Austin, Berlin, and the 4680. For some reason, the market is reacting negatively to Tesla's strategy of passing savings on to the consumer and then selling them FSD in the future. Does the market not believe that FSD is going to be solved? Because I don't think that betting against Tesla has paid off in the past, and I don't think it's going to in the future.
Honestly, it was depressing. I think Elon sounded tired. He sounded deflated. There's a lot going on with the Cybertruck ramp. It sounds like, they're going through a tough time. I think he, maybe distracted a little bit about what's going on Twitter. And obviously geopolitically, there's a lot of things going on. So I think he's worried about interest rates and the economy is slowing down. So all that came out in the conference call. Elon is someone who wears his heart on his sleeve. He's not scripted. He goes in however he feels. You can hear it in the conference call, and that was yesterday.
I'll play a clip for you guys of the only time I thought Elon sounded depressed on the earnings call.
I mean, you have to say, why did I sleep in the factory so many times? Because it mattered.
Other than that moment, it literally sounded like every other earnings call to me. There was various points where Elon was laughing. And I think he only sounded sad on that clip because he's talking about something he's passionate about that nobody seems to be able to understand him on. Many people that are even close to him have been telling him, hey, we need to advertise to maintain our margins. While he's saying, no, we need to drive affordability because people can't afford our cars. And so he maybe thought that showing his emotions was his last effort to convey the truth of the matter in his mind. And look, we hardly ever see S&P 500 CEOs show emotions like that on earnings calls. So a lot of people interpret it as a bad sign. And I'm not one to want to profit off of Musk's demons, but if we learned anything in the biography, it's that when he is sad, usually there's an ensuing work surge at one of his companies. And I think that he might be on the Austin factory lines in these next couple of weeks, ordering thousands of Cybertrucks to be made by a certain deadline. Otherwise, humanity is doomed in his mind. And he comes up with these surges when he's sad because when they are completed, it makes him feel good about the future of humanity again. Hate me, but I kind of interpreted his demons on the earnings call as a positive sign in the next couple of weeks.
Look, long term, I think Tesla's absolutely a buy. No doubt they had a slow quarter in Q3, but people expected that. Tesla had been very forthcoming. They were going to slow down a lot of their facilities as they retooled to make them more efficient and also to give the Tesla Model 3 a much needed facelift with the new Highland coming out. But at the end of the day, I think they're going to come roaring back in Q4. What people don't realize is Tesla's taken the cost down 25% this year. That brings the Model 3 down to about $30,000 after rebate, $32,000 from the Model Y. I think they're going to come roaring back in Q4 with awfully big numbers. But long term, the reality is Tesla owns 50% of the U.S. market. They're selling more EVs than everybody else combined. And they're clearly number one globally. Tesla Model Y, largest selling car in the world, electric or gas. So I think they're pretty well positioned. The big question is, can they stay ahead of BYD? There's a clear number 2 challenger, and I think BYD is going to give them a run for the money. But long term, the whole world's going electric, and Tesla's the king of the hill.
Well, I don't think BYD is a major concern right now. And if we look at AJ's research, AJ's a former analyst at Goldman Sachs and a major Tesla bull. He says, if I read this chart correctly, Tesla outsold BYD in China in September in pure battery electric vehicle sales in the same or higher price range by 3.7 times. As my research unveiled, Tesla and BYD are addressing 2 completely different price segments, and where they overlap, Tesla utterly decimates BYD, even in China. And here's the chart. Feel free to pause the video if you're interested. So a lot of BYD's sales are coming on cars that are costing much lower than Tesla's Model Y and Model 3. But if you look here, BYD's products that are similar to Tesla's, it's hardly a competition. Tesla selling 3.7x more. And if we look at this comparison of Tesla's best-selling model with BYD's best-selling model, I mean, it doesn't take long to notice some of just the improvements and how much better quality of a product Tesla has compared to BYD. And right now, Tesla makes $3,000 per car sold, and BYD makes $136 per car sold. And of course, the average selling price for BYD vehicles is much lower than Tesla's. But as you can see, BYD's margins are razor thin, and that could be why Tesla is taking their time on creating the $25,000 car. Tesla might be waiting to see if those tax credits are going to stick around, because if they don't, then the margins get really thin right now. So I think they're more focused on solving FSD so that when they do make the $25,000 car, this thing is going to blow BYD right out of the water.
Plus, they also have the Tesla Energy division, which is growing like crazy. That may turn out to be their secret weapon.
Tesla Energy gross margin was 24% in Q3, up 33% versus Q2, and 163% year over year. Tesla hasn't even finished ramping up their mega factory yet, or opened their Shanghai Megapack factory. This is starting to feel like the Model 3 and Model Y ramp. We're getting huge margins and we're getting huge growth. And it's crazy. Like, Tesla amazes me because as we're seeing the automotive business, start to come down in terms of profitability, we're starting to see Tesla Energy fill that gap as we head into a crazy tough environment, very cyclical industry. And if we look at James Cat, he says Q4 tends to be the quarter with the highest deployed energy storage deployed in the year. It was this case in 2019, 2020, and 2022. And he says in his next paragraph, the reasons why 2021 Q4 was an outlier. Now, energy storage supply is decoupled from vehicle battery supply, and we have a ramping Lathrop factory. It is reasonable to expect another record Q4 in energy storage deployment, going even higher than what we just saw. And if we look at this chart on energy storage, you can see Tesla in 2023 has almost doubled their storage in 2022 in only 3 quarters. I am so excited about Tesla Energy. And to put this into perspective, Tesla made $500 million in profit in this last quarter. And if we annualize that, that's $2 billion a year. And with Tesla's current PE ratio of 60, that means the energy business right now is worth about $120 billion, which is a significant portion of Tesla's $670 billion valuation currently. So the fact that everybody chose to lament after the Q3 earnings call was sad, considering the great numbers we got out of Tesla Energy.
Virtually every utility in the world is putting as much solar and wind up as possible. They need to store that energy when the sun's not shining, the wind's not blowing, and they're doing it increasingly through Tesla's gigapacks. So Tesla's energy division has grown from 3.6 billion last year to what appears to be something closer to 6.3 billion this year. They can continue that sort of growth. That really gives the company's numbers a boost, and they're getting high gross margins there. But ultimately, the big question here is, can Tesla continue to be a low-cost leader? And I think they're already making plans for the Tesla Model 2. I expect them to see a new model in the roughly $25,000 range come out within the next 2.5, 3 years. And that's something that they can sell globally. If Elon can execute on that vision, I don't think anybody's stopping him. Will there be bumps along the way, delays with the Cybertruck? Without a doubt. But if he executes like he is now, #1 in the world, every auto company going electric, they're in a pretty good place at this moment. And by the way, having $26 billion in the bank for growth, doesn't hurt.
No, it doesn't hurt at all. But some investors want buybacks and they want factory expansion. And like we're going into a potential recession in a cyclical market. And Elon has been a businessman for a long time, so he's very conservative. But if we look at this tweet from Troy Teslike, he says, based on my calculation, it costs $32,000 to produce a Model 3 standard range at Fremont. The battery cost is already low thanks to the cells from China. I estimate that the compact car at Mexico would cost $24,000. Tesla could sell it for $32,000, but the buyer would pay $25,000, assuming the tax credit lasts until the end of 2032 as planned. Tesla's gross margin would be 26% with the tax credit, but only 4% without it. That's probably why Elon is cautious, because it's unclear if tax credits will last. So why would you rush the $25,000 car if the tax credit might go away and FSD is not solved yet? So I think they're being patient, sitting on their cash, being smart, focusing on ramping compute, buying compute, training AI, so that when they do manufacture the $25,000 car, they don't even have to put a steering wheel in it because the cars can drive themselves.
You've seen how many car companies are adopting the Tesla Supercharger Network, or at least trying to get into the Supercharger Network, simply because it's such a huge advantage for anybody who drives an EV. I've been driving a Tesla for 5 years, and having the ability to charge anywhere I go without even thinking about it is just amazing. So the competitive advantage of that Supercharger network is huge. And I think once they open this network to other manufacturers, they can generate between $2 and $2.5 billion in additional revenue just from energy there. And most of which, by the way, is generated through solar. So I think the Supercharger network is just simply underappreciated.
Here's a list of every company that will now be generously generating revenue for Tesla in green, and pretty soon Tesla will earn revenue from basically every car on the road that charges at superchargers. And as he estimates, the opportunity is worth a couple $2 billion in revenue per year, and at a 50% to 80% margin, because what's happening is Tesla's utilizing their ecosystem to get these awesome margins. And they do that by collecting energy from the sun, storing it in megapacks, and deploying that to superchargers to charge people's vehicles. And because you're getting the energy from the sun, it's an extremely high margin. So let's assume Tesla did like $3 billion in revenue at a 50% margin. That would be $1.5 billion in profit. Like, that's enough money to build a gigafactory. And not only that, but they are also starting to get more money from regulatory credits. This quarter, they got $554 million in regulatory credit sales. That's all margin. And there's literally no evidence of that going away. It's only growing as OEMs scale back their EV ambitions. And James Katz says Tesla has a very realistic shot at setting another annual record in 2023 for regulatory credits. They only need to just barely beat their Q4 average from the past of 394 million, which they will crush based on this quarter's 554 million. And like everybody has scaled back recently. So sure, Tesla's price cuts hurt their auto gross margins, but there was a couple awesome positives in the earnings call. And I think the long-term future for Tesla, the outlook is absolutely strong. Going forward, going into the future, Tesla dominates most of the cash flow in the market. So thanks everyone, have a good day.